Well, the Federal Reserve said it may need to push interest rates higher than already planned in order to combat the high inflation weighing on the economy. Our next guest shares that sentiment, even though the backdrop of rising rates is taking a toll on his industry. Joining us now is Appian CEO Matt Calkins. Matt, thank you for joining us today. So this is a very different tone that we're seeing from a lot of other CEOs. Why are you really pushing for the Fed to do more, to be more aggressive right now?
Oh, I think the Fed has to move in order to fight off inflation. I think inflation's been building for a year now, and it's time to take action before the genie really gets out of the bottle. So I'm cheered by the notes that we saw today. I think the Fed has the right factors in mind, and it's going to be necessary to put the economy back right.
And Matt, I got to tell you, this is really fascinating from somebody who's in the business that probably benefits from lower interest rates. Do you think that the path to get back to lower interest rates is to have these punishing high interest rates in the first place, something that the Fed is embarking on and maybe not fast enough, according to you?
No, I think this is a necessary move. The most important thing is we get inflation under control, and particularly the variance on inflation. If we get inflation to be at a predictable level, then the cost of spending money in the future won't be so high. And that's the most important thing for the economy. Just don't put that extra tax on people who are trying to make an investment and create something new. And so I'm in favor of a policy that allows us to have a low cost of money in the long run. And I believe that means raising interest rates now.
And obviously, we still have a very tight labor market, as we saw from the latest JOLTS numbers, but we are still continuing to see these layoffs in the tech sector. Do you think that helps or hurts the Fed's case when it comes to being more aggressive?
Yeah, I think those layoffs are going to continue. There's going to be some of that. And the reason is that our industry, the technology sector, tends to be funded speculatively, which is to say that the first mover advantage is so strong. Being the first in a new market is so important that we're willing to fund a speculative enterprise to get big even before we know that they've tested their model. And when we do that and a recession hits, then we pull back on that speculative financing. And so this is going to be a hard time to get funding for speculative or unproven business models. And I think that's going to hurt this generation of new tech startups. However, it will be fine for tech startups that have already found their audience and have loyal customers. But, this is just the way that the technology industry incubates its next generation. So, yeah, there'll be some layoffs, definitely. We're seeing that from some of our competitors, for example, and you've heard about the hiring freezes.
Coming Wednesday, the Bank of Korea will decide on whether or not to raise interest rates, with a move in favor of an increase, which would mark the first time rates have been raised 3 consecutive times. Experts say that a 50 basis point rise is likely due to worsening inflation, while concerns remain about heavy household debt. Our Lee Dae-yeon has the story.
The Bank of Korea is likely to weigh heavily toward an interest rate hike of 50 basis points on Wednesday. At least that's what analysts predict. The consumer price index rose 6% in June from a year earlier, accelerating at the fastest pace since November 1998. Inflation expectations hit the highest level in about 10 years in June too, with people expecting consumer prices to rise 3.9% over the next year. That's the highest figure since April 2012. Considering the U.S. Fed's recent rates increase of 0.75 percentage points and the rising Korean won-U.S. dollar exchange rate, experts say increasing by 25 basis points would not be enough to tame economic challenges.
If Korea raises 25 basis points instead of 50 points, it could cause problems in the foreign exchange market like capital outflow, as the U.S. already increased its rates by 75 basis points.
In April, the Bank of Korea decided to raise rates by 25 basis points to 1.75. Then in May, it once again raised rates by 25 basis points. Should the Bank of Korea decide on another increase in the coming days, it will mark the first time ever that rates have been raised on 3 consecutive occasions. Some experts say this may lead to shrinking consumer confidence.
Still, increasing household debts will remain as a big issue when considering the big step of raising rates by 50 basis points. Also, corporates could be in danger of bankruptcy due to high interest, which will bring a shrinking employment rate.
Meanwhile, experts forecast the interest rates may reach 2.5 to 2.75% by the end of this year. The figure currently stands at 1.75%. Lee Dae-hyun.
Economy is a very cruel economy. More and more Americans now, 2 out of 3, are dipping into their savings, try to pay for these higher prices and using their credit card more. 26 million Americans who've had their savings wiped out because of these higher prices, and 1 out of 4 report they are delaying their own retirement due to the president's economy right now. Republicans will do the opposite. So we're going to eliminate the COVID-era spending that fueled so much of inflation. Rather than hike taxes on Main Street businesses that would drive inflation, we'll seek to make the lower taxes permanent. You're going to see a concerted effort to reconnect workers to their jobs because, as you know, it doesn't matter what size business you are struggling to find workers. We don't have them to assemble products, man the production lines, deliver them, service them. Unless we get people reconnected, we're going to see higher prices, higher inflation for a much longer period.
In terms of the inflation impact, it's a few tenths of 1%. But when we've got an inflation rate of 8%, that's not a lot. But at the same time, I'm encouraged that maybe the U.S. and China are getting a little closer after this acrimony we've had for several years. We'll have to wait and see. But I think that this will be one of these split the difference decisions where the president will have to do something that organized labor likes, but he's going to have to do something that Janet Yellen likes. He's pretty much out of bullets. I thought that his call for a tax holiday on gasoline was a stunt, and it's never going to make it through Congress. That's pretty clear. He'll go to Saudi Arabia in a couple of weeks. That might have some impact. But no, what's going to bring the prices down of all these commodities is an economic slowdown, and that's exactly what we're seeing in the markets right now.